15 deductions to reduce your tax bill for 2025. What if you're overpaying your taxes without even realizing it? Every year, millions of Americans leave billions of dollars in tax deductions unclaimed. Whether you're a freelancer, a small business owner, or just someone looking to maximize savings, understanding tax deductions is like unlocking hidden money. If you're tired of watching your hard-earned cash disappear every tax season, keep reading. These 15 deductions could help lower your tax bill significantly, and you might not even know you qualify for some of them. 1. Home office deductions save money. What it is? If you work from home, you may be eligible to deduct a portion of your housing costs, including rent, mortgage interest, and utilities. Why it matters? With remote work at an all-time high, more people than ever can benefit from this deduction. In 2023 alone, 27.6% of U.S. employees worked remotely, and that number is expected to rise. How to claim it? Your workspace must be used exclusively for business. Choose between the simplified method, standard $5 per square foot up to 300 square feet, or the detailed method, actual expenses. 2. Student loan interest deduction, another money-saving deduction. What it is? If you're repaying student loans, you may be able to deduct up to $2,500 in interest. Why it matters? With interest rates climbing and student debt surpassing $1.7 trillion, every little bit helps. How to claim it? You must be legally responsible for the loan, and your modified adjusted gross income, MAGI, must be below $90,000, $180,000 for joint filers. 3. Medical expenses deduction. This can lower your taxes significantly. What it is? If your out-of-pocket medical costs exceed 7.5% of your adjusted gross income, AGI, you can deduct the excess. Why it matters? Healthcare costs have soared 17% since 2020, leaving many struggling with medical debt. How to claim it? Save receipts for doctor visits, prescriptions, dental work, and even travel expenses related to medical care. 4. Retirement contributions, early retirement. What it is? Contributions to traditional IRAs and 401(k)s are tax-deductible, reducing your taxable income. Why it matters? A $6,500 IRA contribution could lower your tax bill significantly, especially if you're in a high tax bracket. How to claim it? Check IRS limits. In 2025, individuals under 50 can contribute up to $7,000. Those 50-plus get an extra $1,000 in catch-up contributions. 5. Charitable contributions. What it is? Donations to qualified charities are deductible, whether they're cash, goods, or even mileage driven for charitable purposes. Why it matters? In 2023, Americans donated $499.3 billion, yet many don't claim the deduction. How to claim it? Keep detailed records of all donations. Contributions above $250 require written acknowledgement from the charity. 6. Mortgage interest deduction. What it is? Homeowners can deduct interest on up to $750,000 of mortgage debt, $1 million if purchased before December 15, 2017. Why it matters? With mortgage rates hovering around 6%, 7%, this deduction can offset a chunk of your housing costs. How to claim it? Your lender will provide a Form 1098 showing total interest paid. 7. Energy-efficient home upgrades. What it is? Tax credits for home improvements like solar panels, energy-efficient windows, and heat pumps. Why it matters? The Inflation Reduction Act expanded these credits, covering up to 30% of installation costs. How to claim it? Keep receipts and manufacturer certification statements for qualifying improvements. 8. Self-employment deductions. What it is? If you run a business or freelance, you can deduct business expenses like software, travel, and advertising. Why it matters? Self-employed individuals pay 15.3% in self-employment tax. This deduction helps offset those costs. How to claim it? Track all business-related expenses throughout the year and report them on Schedule C. 9. Child tax credit. What it is? A tax credit of up to $2,000 per qualifying child under age 17. Why it matters? For lower-income families, up to $1,400 per child is refundable, meaning you get money back even if you owe nothing. How to claim it? The child must have a Social Security number and live with you for more than half the year. 10. State and local taxes, SALT, deduction. What it is? Deduct up to $10,000 in state income, property, and sales taxes. Why it matters. This credit is especially beneficial for homeowners in high-tax states like California, New York, and Illinois. How to claim it. Keep track of property tax bills and state income tax payments. 11. Dependent care credit. What it is. A credit covering up to 35% of child care expenses worth up to $3,000 per child. Why it matters. Child care costs have jumped 19% since 2020, with daycare now averaging $10,000 per year. How to claim it. Expenses must be for care that allows you to work or look for work. 12. Casualty and theft losses. Adobe stock. What it is. Losses from federally declared disasters may be deductible. Why it matters. In 2023, there were $28 billion disasters in the U.S. affecting thousands of homeowners. How to claim it. File Form 4684 and attach it to your tax return. 13. Health Savings Account, HSA. Contributions, Joint Saving Account. What it is. Contributions to an HSA are tax-deductible and withdrawals for medical expenses are tax-free. Why it matters. Families can contribute up to $8,300 in 2025, reducing taxable income. How to claim it. You must have a high-deductible health plan, HDHP, to qualify. 14. Moving expenses for military members. What it is. Active duty military can deduct moving expenses related to a permanent change of station. Why it matters. Relocation costs can run $5,000 or more. How to claim it. Keep receipts for transportation, lodging, and storage fees. 15. Adoption credit. What it is. Covers up to $14,440 per child in adoption-related expenses. Why it matters. Adoption costs range from $15,000 to $50,000, making this a crucial benefit. How to claim it. Must be filed with Form 8839. Final thoughts. These 15 deductions. They're your key to keeping more of your hard-earned money. Tax season can be frustrating, but knowing what you qualify for could mean the difference between a big refund or a painful tax bill. The best move? Start planning now. Remember, it's not about the amount of money you make, but the deductions you take that truly matter. If you're feeling overwhelmed, it's always a good idea to consult with a tax professional who can help guide you through the complexities and ensure you get the best refund possible. Yes, you can deduct the cost of hiring a professional to prepare your taxes. If you paid an accountant or tax preparer to handle your return, the fees can be deducted as a miscellaneous expense. However, be aware that the tax laws surrounding this deduction are complex, and it is best to consult with a tax professional to ensure you meet all the necessary qualifications. Ready to take action and make your tax year easier? Get those deductions lined up and let's reduce that tax bill.